First of all, I'd like to say we're delighted with our half-year results till June 2019. Clearly for us, income is the most important thing, and we're currently yielding 8% dividend, so one of the highest in the sector. We're on target to pay our full year forecast of 8.25 pence per share, which is 3% up on last year, continuing our progressive dividend policy. And therefore, income very robust and looking good for the future. Just turning a little bit to the debt side, we did some reorganising of our debt in the first 6 months of the year. 2 new facilities, taking our average debt term in terms of unexpired debt term to just under 8 years. That's at 3.5% fixed, so we are either wholly fixed, hedged or swapped, therefore no interest rate risk. We completed a number of lettings and renewals in the first 6 months, and I'm pleased to report that we are 5% ahead of ERV on average in income, and that's showing a story of rental growth across our portfolio. And that's the third period that we've seen that rental growth, so 18 months to me is showing sustained rental growth. We foresee that continuing into 2020 and beyond. Finally, the loan to value, we've reported at 39.9% at the half year, in line with our target of 40%. We're delighted, we went to market in June to raise £50 million, oversubscribed, very much supported by our existing investors and indeed a number of new investors. So the raise of £62.5 million was very pleasing. That will be deployed to take advantage of what we see as a buyer's market. Very few buyers in the market at the current time, just given the Brexit debacle. We also see encouraged and willing sellers, particularly from the open-ended institutional funds, who have seen a raft of redemptions and required to sell assets to pay back investors, and from our usual source of private equity houses who are at the end of strategy. And we've been very successful in acquiring portfolios from them over the course of the last few years. We've agreed a number of deals and are in solicitors' hands, and we hope and expect to have deployed all of that money raised by the end of December this year. Let's look at the industrial market first, and then we'll come on to the office market, our 2 chosen sectors. The industrial market, we chose strategically to sell over 40% of our industrial holdings last year, as we foresaw a slowdown in the industrial sector, not in terms of occupation, but we definitely did see rental growth or expected rental growth to slow, and indeed that's exactly what's happened. So rental growth has been slowing. IPF consensus forecast going forward shows that slowing to 2.1% over the 2019-2023 period. That's less than half what we've seen over 2016, 2017, 2018. That's also impacting total returns, where total returns in the industrial sector are 5.7% average over the same 2019-2023 period. So whilst industrial will perform, they'll perform at a slower rate, and I think vindicates our decision to sell over the course of 2018. Moving on to the office sector, obviously we have been reinvesting the proceeds of our sales into offices, and indeed the proceeds of the raise will also be invested into the office sector, where we're seeing rental growth increase. So I think we're well placed to benefit from that rental growth. The regional markets are performing well, very robust take-up numbers, lowest vacancy rate in 13 years. So we are really seeing some growth in that sector. Having said that, obviously we had 10 years of no growth post the 2007-2008 period, and therefore wholly expected. And I think the general consensus is that office rents will invert in terms of growth versus industrial, where offices will outperform industrial in the regional markets, and we were very well placed to benefit from that. Over and above the rental story, we expect large amounts of capital to be attracted to the regional office markets, chasing that rental growth and still relatively high yields, and we think that will put pressure on yields, and capital values will improve because of that weight of capital seeking quality investments in the regions. For the rest of you from Regional REIT, we are very much expecting rents to continue to see upward pressure on our office portfolio, which makes up almost 80% of our asset space, and therefore we expect to see steady performance in rental growth. Very little will change in our view in respect of the investment markets, which will remain subdued. Investment volumes are down. on the 2018 numbers, and that really is in reflection of the political uncertainty we're seeing over Brexit discussions. We anticipate that once certainty is there, and we just don't know when that's going to be, but once we do have certainty, we expect the capital markets to reflect that in upward investment and volumes increasing. But that will probably be in 2020, not over the course of the remainder of this year. So in summary, our occupational market is very strong. We're going to take advantage of a weakness in the buying market, in investing the proceeds of our raise, and I think all set fair for improved income profile over the course of 2020 and beyond.